Great. Good morning, everybody. It's lovely to see you all. My name's Brady Last. I'm the COO of the IAB and I'm hosting today's coffee morning. Sarah says hello to you all, but she's not in the office today. This is the coffee morning for the IAB on the 20th of May, 2026. I know I haven't met you
The
all.
Bluetooth device is ready to pair.
Sorry there, I heard someone's not on mute. Um, yes, so I know I met quite a few of you at the at Accountex this week. So it was last week. It was really lovely to meet a lot of you, but I know I haven't met all of you. I have been with the IAB for just over 2 years. And yeah, looking forward to meeting more of you today and as time goes on. So I am just going to sorry, I was just checking that everybody can hear me. Um, okay, so today, really looking forward to both of our speakers. But before that, I did mention about Accountex. So last week, when we were at Accountex, Sarah did film a short video, which I'm going to attempt to share and play with you now. So please bear with me as I do that. Never happens as quickly as you want it to, does it? Mariska, can you let me know if you can see the screen?
Yep, it's all good.
Right, I'll just put it now. One of the big conversations that's happening here at Accountex today is about AI. And there seems to be a real mixed bag of emotion around it. Some people are quite fearful, others are quite excited by the opportunity. I've just come off the Zero stand, and what's been really interesting to hear today is that they just released their first AI version today, which is, I think, really, really helpful for the whole industry. So, I mean, I've had my own practice now for 20 years, and I think we've seen a lot of changes over that time. We've gone from being compliant, advisory. I see the industry going for finance professionals to be much more strategic in their support for their clients, and AI is going to be an absolute fabulous tool for that.
What if you could clean your retainer at the touch of a button? No more brushing or tablets.
Sorry,
Over
everybody.
4 years ago.
I was just trying to stop sharing. Have I stopped sharing, Mariska? Yes, great. Thank you. There we go. Right. Um, right, so we'll move on to our speakers. And we're going to start with Dan Murphy Moore from Fathom, who's one of our member benefits. His presentation is going to be on the questions that your clients are asking. Dan is an account executive at Fathom, where he works closely with accounting firms to help them get more value from their financial reporting and advisory services. Over the past 20 months, he spent his time in the accountants channel listening to the real questions clients ask and helping practices use Fathom to answer them with clarity and confidence. Over to you,
Perfect.
Dan.
Yeah, thank you very much, Brady. Just make sure you can see my screen okay. Let me try again. Good old
Not
Zoom.
quite yet. I think it's coming now.
Hopefully it's coming up. Cool. No, thank you very much and good to be here. You may well have seen my face at Accountex if you were there, like Brady says, I'm Dan. My role inside of Fathom is I look after accountancy practices predominantly and onboarding them with Fathom. What I wanted to cover today is the questions your clients are asking, perhaps some of the challenges you're finding, and how we can start to answer those with inside of Fathom. And this has come off the back of a survey we recently ran to our accountancy practices, some of our clients. So what we found was 44% of UK accountants and bookkeepers said cash flow is the number one question that they're fielding right now. But it wasn't just cash flow that came to light. UK practitioners are fielding more pressure more frequently across every area of the business. So like I said, 44% of cash flow say cash flow is the top client question right now. And that's expected to rise to 51% next quarter. But what we also found was 40% are being asked about profitability and margins, which again we found was the highest proportion of any region globally. And 30% were being asked by their clients, are they on track versus that business plan? Are they on track versus budget? And like I say, UK practitioners are leading adoption because the questions are demanding it. 77% of UK Fathom users said the platform helped them answer their toughest financial questions this quarter. And 47% of UK Fathom users are using forecasting, which again was higher than any other region. So a quick question from me, and if you are able to use the chat to do this, do you currently offer forecasting as a service to your clients? Perfect. So a few answers coming in. Yes, no, yes, no. Most important things to offer. That's good to hear, Tanya. Yes, zero is great. Currently use Fathom and love it. Brilliant. Thanks, Jen. No, no, no. Sometimes. Cool. Okay. Currently use Fathom and love it. Brilliant. Okay, so quite a few answers coming in and a very mixed bag. Some are using Fathom already, which is great to hear. Some perhaps aren't offering it to clients and some are offering it. So this publish falls in line with some of the challenges you currently hear, or we currently hear. It can be time consuming to build forecasts, whether that's via Excel. It also can be prone to human error. It requires ongoing updates. It can be hard to adjust quickly to your client's questions, and it can be difficult to account for sudden changes. And we understand that, and that's why we want to make it as simple as possible for you. So let me just jump into Fathom. Let me show you a few things and how we can answer these questions for your clients. So within Fathom, we want to make things as simple as possible for you. So the idea here is we would link into your accounting software, whether that's QuickBooks, Xero, Free Agent, or so on, and we will pull that financial data into Fathom. Now, once it's in, that will be constantly syncing the latest financials because we want to get this to a place where this system should run itself in the background. And therefore, you can spend the time having the conversations with your clients, adding value to your meetings rather than spending the hours building these forecasts and building these reports. So let's talk about how we can build a forecast for a client with inside of Fathom. Now, when I speak to accountancy practices and businesses, I always ask, when you're building out these forecasts, if you are building forecasts, what assumptions are you building these out from? And the common answer I get is we look at the last 12 months data, we look at the last 2 years data, and we kind of make projections based off that. Now that can be challenging because again, you've got to look at the last data month by month, take assumptions and build out from there. Now within Fathom, we can import that data from the financial system and we can build a forecast for you within around 5 seconds. So let's see how quick that can be. We quick start forecast. And what we've got inside of Fathom is a tool that's designed to look at that historical data for you. So we can look at up to 2 years data. We can recognize seasonality. We can recognize certain trends that the business may have, and we'll make the projections for you based off that. Our forecasting is 3-way. So we'll look at profit and loss, we'll look at balance sheet, and that will drive a cash position month on month. And that's a rolling forecast. Now, that may work for some clients. Again, you could say, right, we've built a forecast for them looking at historical data, but it might not work for all of your clients. So you can get granular if you need to. and having conversations with your clients, seek different assumptions. So like I say, we could be looking at a value rule where we look at historical data and the system does our heavy lifting for us, and we can include seasonality. But we might want certain clients be having certain clients that have certain growth. They've had huge growth on last year's numbers, and we might want to implement that within our forecast. And again, Fathom can do the heavy lifting for you. We can pull the numbers from last year. We want to see that with a 20% increase. We hit create rule, and that's going to do the heavy lifting for us again. And like I say, it can be as simple or as complex as you need to be within here. You might have clients that can do revenue all as the same assumption. You probably have clients as well that need a bit more detail and to go in line by line for different assumptions through revenue and cost of sales. Now, there could be other assumptions as well. We could say we have a set marketing fee from a certain client that we know stays the same each month. So we can tell the system that revenue line stays the same at 5,000 a month. We may even want to see it grow quarter on quarter by 10%. All you've got to do is hit create rule and Fathom does the rest for you. You don't have to go and manipulate any formulas. And then the other way we can make assumptions, we can create formulas using drivers. So if you have that client who perhaps needs that further granularity, has very precise assumptions they have, whether that's different number of units at different prices, different products, you can bring these into Fathom and then use those to create drivers. So like I say, if your client hasn't built a forecast before, if they haven't got a budget, Fathom could have one ready for you very, very quickly. And you can then go into the system and perhaps get a little bit more granular and add
Bluetooth
further
device
value.
is ready to pair.
Hopefully that gets paired. So then we've got the second fundamental, which is our timing profiles. And this is effectively when the cash is collected. And again, you can get going as granular as you need to, line by line here. You may have clients that have campaign revenue on 30-day terms. So we'd go in here and tell the system that's all collected on the same month, and we create profile from there. As soon as we do that, that's then going to have a direct impact on our cash flow. Again, we can split this out however you need to, whether that's taking deposits up front, we recognize X amount 6 months prior, you can split it however you need to. So that's how we can start to build out the profit and loss. From there, again, we can forecast via balance sheet, and you can map in any movements on here, any depreciation of fixed assets, and any journals in there. And those two together are going to drive a cash position for your clients moving forward. That very much looks like this. Now, that's a great tool in itself. And like I say, you could even use that if your client doesn't have a budget to save the forecast as a budget. And then what you're going to be able to offer your clients month on month is that actuals where they currently sit, which we pull from the accounting system, versus that forecast, versus that budget with variance month on month. So that's a really, really clever tool in itself. But where I always think Fathom really adds value for your client meetings is these few elements on the side here. Because what we can start to answer here is different assumptions your clients may have. What can we afford to hire is probably a common one to get at the moment. What happens if we win this contract? And Fathom allows you to manipulate the system and layer these on top of your baseline. Let me show you very quickly how a few examples of this. Your client wants to make a hire. They want to see the live impact it has. They want to see if they can afford it. We can tell the system here, we want to make a new hire in March 2026. And we hit create. Fathom's then going to give you 3 wizards that are the most common. And if they're not applicable, we can start from below. But let's say we're going to employ someone on 50,000 a year, and we know that's going to have an impact on our salaries. And what we've got here is almost an isolated situation for this particular hire, because as you can see, Fathom's done the rest for you. It's recognized from that 50,000 salary, the difference that has on us as cash and equity and a final position at the end. Now I can get more granular if I need to for this and have the conversations with your clients, because I can say, yes, we're going to hire someone, but actually this is going to come with a level of revenue as well. And again, I can tell the system when we're collecting that revenue, when we're collecting that cash. Let's say for the instance of this, they're going to start at £1,500 a month revenue, and we want to see that implemented quarter on quarter by 10%. I create rule, and like you can see, Fathom's done the rest for me. I can then tell the system when we're collecting cash. Now, how this can also be impactful is it allows your clients to make those business decisions. We've got our baseline forecast, and we can very easily turn these on or off as frequently as we like. So let's see the impact if we do make that higher in March 2026. Let's turn it on. Let's see the numbers move in real time behind us. Let's allow your clients to make those business decisions. And again, that could be a new hire, a new contract. They might want to make a purchase. They might want to take out dividends payments. They might want to see NI increased. They might move to another premises. All these different what ifs, all these different difficult questions your clients have. Fathom can allow you to visualize these in different ways. Now, what we can also do off the back of those what ifs is we can look at the timing impact that these may have. Now, perhaps your client desperately wants to hire, but perhaps they don't feel March is the best time. You can start to answer the question of when is a better time. And like I say, we can pick this up and move it. There's no formula behind it. You haven't got to say to your client, let me come back to you in a week's time. Let me manipulate the Excel spreadsheet. Let's pick it up. Let's move it to June and let's see the live impact that has on your forecast. And that allows your clients to make those business decisions. And now, piecing that all together off the back of that, what you can also do with your clients is you can run unlimited scenarios within Fathom's forecasting. Let's create one here. We've got our baseline forecast. Let's call that our budget. But we want to see that if we employ this person. And because of this, perhaps we also want to see if we increase revenue by 15% or we decrease cost of sales by 5%. We name the scenario, we create the scenario, and then again, you can flick between these scenarios in real time. Perhaps you want a best case for your clients, perhaps you want a worst case. And again, these numbers change. Let's allow your clients to make those business decisions. So that's a high level of overview of our forecasting tool, not only how you can build that budget or baseline forecast, but how you can also help your clients scenario plan, answer some what if questions. Now, how do we piece that all together within Fathom? Fathom then brings data together and a final output through a monthly reporting process as well. And what we want to do here is we want to get the information across to your clients because sometimes the challenge is your clients aren't from financial backgrounds, spreadsheets are complex, there's a load of numbers on the tables. How do we simplify it for your clients? How do we make it far more digestible? And here they're completely bespoke. These reports are built for you if you want. We have templates that are already there. You can bespoke them to your client's logo, your client's brand colors. You might want to standardize your reporting across the board and have your logo and your colors. And that's very easy to do inside of Fathom. And then, like I say, I mentioned the video earlier mentioned AI is a hot topic at the moment, and it absolutely is. We've just released within our tool AI commentary. So this text here can actually all be done for you now, because we've got a system that analyzes data, whether that's profit and loss, balance sheet, KPIs, whatever it needs to be, and we'll simplify it and we'll build it for you. But then it's very much how can we get it across to your clients? Here's a focus here, let's say gross profit margin, or let's say net income. We simplify the metric. Fathom will work out the variances for you, whether you want to compare to last month, last quarter, last year, and it's red versus green. It's very, very easy to follow if you're a director, if you're at board level, to see where you are as a business. Now, there's lots we can do within KPIs and bringing other data into Fathom, but then it's very much how do we get the information across to your clients? And there's over 100 different charts. Everyone loves the visualization, customizable right down to colors of the lines. Again, you can look at revenue, you can look at expenses, whatever information you think you want to get across to your client, you absolutely can. But like I said, in Fathom style, a lot of the heavy lifting could be done for you. The KPIs are built for you. They're there, they're ready to use. The templates are there. The forecast can be built for you very quickly. So again, you can spend the time having conversations with your clients. And as you come further down this report, you'll start to see we can break down expenses. We also perhaps want to get our P&L, profit and losses, across to our clients, and we can do that in a very neat way. Perhaps we want to offer the value of their monthly actuals versus that budget we perhaps built in our forecasting tool very quickly. And this month versus budget. Red versus green, again, very, very easy to follow. And we come further down the report, KPIs we can focus on there, different ways to visualize those. Fathom also calculates a break-even analysis for your clients, looking at revenue, total costs, break-even point and a margin of safety. And then we come into current cash flow position as well. So we'll analyze that data from Xero QuickBooks, and we can also give your clients a current cash flow position, as well as that future cash flow. And then you come to the final piece, like I said, so forecasting in there. How do we bring that data to life? Far more visual than that tables. Yes, it's great to look at it this way. Here's where we are for the year. Here's where we're predicted to go. But what do most clients resonate the most with? The visualization element. Here's where you are. Here's where we think you're going to go as a business. These are the reasons why, from a baseline perspective or from a budget perspective. But actually, you've mentioned potentially winning that new client or having that new contract or making 2 new hires. And if those things do happen, could end up there as well. And perhaps it's also good to understand the other side. If you lose that big client, if that contract does get delayed until next year, again, you could end up down there as well. So that's very much Fathom as a high level overview. Hopefully it's been beneficial. Hopefully I've shown you forecasting doesn't have to be complex. It doesn't have to take hours and hours of your time. And just final piece from me is we offer a 14-day free trial. It's as if you're a paying subscriber. Being an IAB partner, you also get 20% discount off your first 12 months. And if perhaps what I've shown you today is of interest, feel free to contact me. We can jump on a call. We can look at it one-to-one. We can answer any specific queries you have. But thank you for your time, and hopefully there's some questions I'm happy to answer.
Thank you. Thanks for that, Dan. I was just having a look to see. I think one of the questions was around me. I shared the picture, I shared the page of our website with the member benefits on it. So please, would you share a link to Fathom in the chat, Dan, so everybody can look at that. Thanks so much for giving up the time. I'll wait and see if any questions come up. I was just going to ask, and I know you were talking about that report. I had a couple of questions about that. How long does it take to actually create that report? Is it a push of a button thing as long as everything's populated, or how long would that take if you wanted to create one of those for your clients?
Yes, the idea with Fathom is we want to make it as easy as possible for you to drive these conversations. So the data comes in instantly from, let's say, zero. You can jump to reports and you'll see templates that are already there. They're pre-built, anywhere from 3 pages on cash flow right up into a 14-page monthly performance report. So you can have a report ready within 10 seconds. And then, yes, you can tweak those if you want to tweak those. But then reports are there. They're ready to be built.
Because I was going to ask about the manipulation, because I think, we have lots of conversations about AI, and obviously that's a really hot topic. I don't know if everyone's sick of hearing it. It's a hot topic, but it is. It was talked about. So, every other conversation, Accountex was around it. And I suppose the thing that's important for, I guess, everybody listening today and our members is that human element. They are still needed, and that kind of human manipulation part is really important. So when those reports are created, how easy are they to manipulate? Do you have to go back into the system to do anything? Can they be manipulated on the document? It looks like a PDF, so I was thinking from that side.
Yeah, good question. No, so Fathom's focus is we want to make it very user friendly, which is common feedback we get. So our reporting is all tweaked inside of one place. So yes, I've just shown you the PDF variant, and that's one way you can present to clients. But when it's digital, you build it within one system. You can add in charts, tables, you can tweak it. But one thing I would say is if anyone here is interested, they want to jump on a further call, please do get in touch. I'm happy to do so. But there's also a huge element of support available with Fathom. So we have a 24/5 support team. Average response time is around 6 minutes. You get a dedicated account manager. So someone like myself, you can jump on calls with. They can assist you. They can tell you what other practices are doing, how they're selling these additional services.
Yeah, and I think, Tanya, thanks so much for that comment. I can't sing the praises of Fathom enough. It really has been a game changer for me. So that's good to hear. And I think what the thing for me with these kinds of tools is it's interesting you said we called the presentation the questions your clients are asking, but also this enables you to answer questions your clients perhaps didn't know they had, and provide them with something really simple and just say, here's an example. So something in passing, like making a new hire, for example, or starting a new project, to be able to model that for them and say, it's your decision as the business owner, but this is how easy it is to potentially look at what that actually might feel like for your cash flow. So yeah, it helps to have the conversations, I guess.
Yeah, absolutely.
Cool. Well, thanks so much, Dan. I don't think there are any other questions, but if you do have any other questions, there might be some time at the end, so feel free to pop them in. And Dan, will you share some links on the chat so everybody can see that? But yeah, thank you again for giving up your time today.
No problem. Thanks for having me.
Thank you. So now we're going to move on to our second speaker, and delighted to welcome the Pensions Regulator, the UK body for making sure that workplace pensions are properly run. I'm sure the pensions regulator speakers will redefine their role if needed. I'm just going to introduce them via their bios today. So we've got Sam Lorry. Sam is the Payroll Specialist at the Pensions Regulator. He joined the Pensions Regulator in August 2024 and responsible for engaging with payroll software and middleware providers to improve AE compliance through better regulatory understanding and the promotion of robust products and services for employers. With a background in both payroll software and managed services, he draws upon this experience to provide specialist support to TPR's compliance and enforcement activities and offer expert guidance to internal and external stakeholders. And we also have James Wiley. James currently works within the Market Oversight Directorate on scheme supervision. He joined TPR in 2013, whilst AE was being launched to employers, working within compliance and enforcement, focusing on helping employers achieve compliance, undertaking regulatory action inspections. James now predominantly works across industry, having built relationships with the largest and most influential Master Trust and GPP schemes. He manages AE-related matters at scheme level and is responsible for driving industry towards improving data accuracy, oversight systems and processes concerning employer payments and scheme reporting duties. So thank you very much. I'll pass you over to Dan now. I'll put myself on mute, and please do keep the questions coming.
Thank you, Brady. Hopefully you can hear me okay, everyone. I'm just working to get my screen up. Can you see that now? Thumbs up, Brady.
Just coming, I think. It's just saying, it says it started screen sharing, so it usually takes a second.
Okay, well, any moment you'll hopefully see my purple slides appear, avoiding AE errors. Please just let me know when we do. Good morning, everyone, and thank you for having us here. My name's Sam Lorry, and I'm a payroll specialist at TPR. So I work alongside our compliance and enforcement teams on our employer-facing work, looking after inspections, and also look after our sort of engagement with the payroll software and services providers. So I'm going to kick things off today, and then pass over to James. Hopefully we'll have some time for questions at the end. Otherwise, if we run out of time, we're more than happy to take those away with us.
Sam, I think you might need to reshare. Sorry, it's still not come up, unfortunately.
Right, bear with me a second.
Yeah, thank you.
That's it.
Have you got it?
Yep, thanks.
Yeah, great. Okay. Today I'm going to talk about the employer's duties for pensions and automatic enrolment, looking at some of the most common errors that we find when we go out on our employer inspections. So first of all, just a quick definition of what the employer's duties are when we're talking about workplace pensions. These include the provision of a qualifying pension scheme for automatic enrolment, the ongoing assessment of the workforce, needs to be completed each pay period, with the workers being assigned an AE category. So that will be depending on their age and their earnings. Workers will be assigned either as eligible job holders, non-eligible job holders, or as entitled workers. So currently, those thresholds are age 22 and an annual earnings figure of £10,000, and that's prorated down to match the pay frequency. So £833 monthly, or £192 weekly, for example. So when a worker meets both of those conditions, they'll become an eligible job holder and they need to be automatically enrolled. If the worker meets just one, either age or earnings, they'll be a non-eligible job holder and they can choose to opt in. And entitled workers are those within that age range, but earning less than £6,240 per year. So if you have entitled workers, they can join the scheme, but employers do not need to make contributions on their behalf. So you can find the full details of each of those categories and the responsibilities around those on our website. But once the worker's in the pension scheme, whether that's by automatic enrolment or by opt-in, the employer needs to pay minimum contributions over into the scheme. So they must provide all of the statutory information to the worker within the designated timeframes, usually 6 weeks. They need to manage opt-ins, opt-outs, refunds, and any joiner requests. They'll also need to keep records relating to auto-enrolment for a period of up to 6 years. And every 3 years, they'll need to re-enroll all eligible workers into the scheme. So at the first duties date, the date the duties come live, the hire date of the first worker, the employer will need to prepare a declaration of compliance, stating that they're compliant with automatic enrolment, and then this exercise is repeated every 3 years along with the reassessment. So some of you on the call may assist your clients, the employers, with their duties either directly or indirectly. One thing that's really important is to just make sure you've got clarity between both parties, who's looking after what. Because we do quite regularly see employers who tell us, they've missed some of their AE duties, and it's because they thought their accountant or their payroll provider was picking it up for them, when in fact they weren't. So how do TPR pick up on AE breaches when they happen? We have a range of mechanisms at our disposal. These will include the use of RTI data, that's the payroll data submitted to HMRC, reporting coming down to us from the pensions providers, whistleblowers within the workforce, and also employers self-reporting to us, following an audit, they'll come and say, look, we've got this wrong historically, can you help us fix it? We also have an in-house intelligence function, and we work closely with other agencies to identify both individual cases of non-compliance and also wider systemic risks. So when issues are found, we have legal powers to demand information from an employer, and also to enter the premises for inspection. So it's a criminal offence to fail to respond or to supply any false or misleading information to us. But typically our preferred approach is to work collaboratively with an employer to make sure that all workers are restored back to the position that they would have been in had the error not occurred in the first place. So some of the issues that we come across may relate to how things were, how the pension scheme itself was set up and configured in payroll right back when the employer first started out. And when an error is made like this, it can sit there in the background undetected for many years. And when that happens, restoring those workers back, often all the way back to the staging date, can become quite a costly task. So it's really important just to make sure that these common issues we're about to go through are regularly reviewed, particularly when you're taking on new clients that may have had a history processed by someone else. So what are the issues that we see quite regularly? I'm just going to run through a few examples. So these are some of the issues we see time and time again, and this is across employers of all sectors, all sizes. So first example here, making sure that pay elements are being defined correctly for both pensionable pay and for qualifying earnings. So it's important to consider these might not be the same thing. The definition of qualifying earnings is available on our website, and that sets out the payment types which need to be used for the automatic enrolment assessment to see whether workers are hitting that trigger. Many sort of the newer pension schemes that were set up explicitly for AE will mirror the qualifying earnings set as their pensionable pay, but there's plenty of schemes out there that have their complete own separate definition of pensionable pay. So when the pensionable pay definition is different to the qualifying earnings, the QE set, the qualifying earnings set, needs to be used for AE. And then the scheme's pensionable pay elements should be used to calculate the workers' contributions. If an employer is operating more than one pension scheme on the payroll, then you might end up with different element sets used for each pension scheme. So some schemes out there may apply thresholds to pensionable pay. This is one we see people getting wrong quite a bit. It means that the calculation of contributions is based on the pensionable pay between an upper and lower limit on the earnings. For qualifying earnings schemes, those limits are reviewed annually. Therefore, it's really important to make sure that these are reviewed at the start of each new tax year to make sure you're in line with the new rules. And the same with contribution rates. Those have been increasing over time. And it's really important that the employers at least meeting the current minimum rates. One way we see people fall down here is where employers might set up a pension deduction to be a fixed cash amount on their system rather than it being calculated dynamically as a percentage of pensionable pay. It just means when the contributions are set as a fixed amount, any change in the worker's pay can lead to a breach in those minimum contributions. So worth noting all of those points there, the elements, the thresholds, etc., should be reviewed regularly. And when any new payment types are introduced to an employer on the payroll, etc., make sure that the status of that new element, that new payment type, are being carefully considered and set up correctly. Another one just worth a mention here are timesheets. This comes up quite a few times where an employer might not quite understand how to correctly calculate contributions for workers paid by timesheet when they withhold timesheets for a period of time and then submit several at once. So they might relate to a period going back maybe 6 months, for example. What's important here, the contributions are calculated in the pay period that the payment is due to be payable. That definition is determined usually by the worker's contract of employment. It might say that we pay the hours worked in the pay period after they're submitted, subject to a payroll cutoff. So it doesn't matter when those timesheets were worked; it's when they are, what the process says that the payment should be payable. If the contract is silent, then the normal process becomes the expected process. Now, I'm just going to look at a couple more issues in a little bit more detail, starting off with tax relief methods. So to be clear here, each pension scheme will only operate a single prescribed method of tax relief for the workers' contributions. So the pension scheme will either be relief at source or net pay arrangement. The terminology can cause a lot of confusion because tax relief at source doesn't actually reduce the worker's taxable pay in that pay period. And net pay arrangements, the contributions are calculated before net pay. So it causes a little bit of confusion. Some providers will offer products for both types of tax relief. Some certain providers will offer just one. So it's important just to clarify with the provider which one is being used. Using the wrong method of tax relief can result in either doubled up tax relief for the worker or they receive none at all. When I hand over to James shortly, he's going to cover the implications of that in his section. But fixing this can be particularly fiddly because it's not just the workers' contributions that needs rectifying, but also quite often the workers' taxable pay history will be incorrectly recorded too, because net pay arrangement contributions will reduce taxable pay. So worth mentioning here as well, when pensions are contributed by salary sacrifice, the base method of the pension scheme is still either relief at source or net pay. It's just that the employer is making the entire contribution into that scheme on the worker's behalf. So because there's no workers' contribution, there's no workers' tax relief method apparent because the employer is making the whole thing. That said, sort of in practice and sort of through the lens of looking at it from a payroll person, the portion of salary that the worker's sacrificing behaves in a similar way through payroll as a worker's pension contribution, as the salary that they're giving up for the employer under the contract is usually the equivalent amount that their sort of workers' pension contribution would be. So although it's technically not a third method of tax relief, because it kind of works like similarly to one through payroll, I thought I'd include it on this visual for you as well. But we can see here going across the screen from right to left, the effect on taxable pay and NIable pay, pay subject to national insurance, I should say, for each of the relief method types. So for relief at source, we can see that the pension contribution itself has no impact on the taxable pay or pay subject to national insurance in a given period. For a net pay arrangement, the pension contribution will reduce the worker's taxable pay by the amount of the pension contribution, but has no bearing on their pay subject to national insurance. And with that, technically not a third type of tax relief, under salary sacrifice, both taxable pay and pay subject to national insurance will reduce in the pay period, because obviously the worker's giving up that pay entirely. So finally, I'm just going to take a look at maternity leave. This is an issue. Pension contributions in maternity leave is an issue we see time and time again, with even the biggest, most established employers out there getting this one wrong. So what I'm going to give you is a rule of thumb, but I really recommend checking with the particular pension provider in all cases. So as a rule of thumb, the employer's pension contributions during maternity leave should be based on the pay that worker would have received had they not been on leave. So that makes sure that they're not being disadvantaged for being on a period of statutory leave. So usually a notional normal pay figure is used to base the employer contributions on. So for salaried workers, that's quite straightforward, but for, just base it on their normal salary payment. But for variably paid workers, a method of calculating the normal pay needs to be introduced. So there's no specific method set out in legislation. So the employer has some discretion there to determine what the most appropriate way of doing this is for their workforce. So for example, it could be average pay over the last 12 months, or it could be, based on the average weekly earnings figure that would have been calculated to work out the higher rate S&P already. The key thing is, as long as the employer can demonstrate that the method they're using is fair and that it meets the intentions of the legislation, it's acceptable. So from the employee side, there's no such rule to maintain contributions based on a sort of notional full level. So typically the workers' contributions will be based on the actual pay that they receive in that pay period. So the employer's based on the notional full salary and the workers based on the actual pay. An additional consideration there is the implications of salary sacrifice pensions in maternity leave. So in periods where the worker's receiving statutory pay, S&P only, they won't actually have any salary available to sacrifice to the pension. You can't sacrifice the statutory pay. But the employer has already contractually agreed to pay over a certain percentage of pay to the provider. So the employer will need to continue paying that full pension contribution for both the employee and employer equivalent over to the pension provider, even though the employee is not sacrificing any of their own pay. Now, just worth mentioning again, what I've just gone through is just the rule of thumb. And there are some instances where there's going to be exceptions to that rule. So some pension schemes will set out different expectations in their scheme rules, and that's particularly the case with defined benefit schemes. So it's always best to check with the pensions provider to avoid any doubt and avoid any errors. As I say, it's a really common issue that we see time and time again. So that concludes my section. I'm going to hand over to James now to give a quick introduction and go through his section. Hopefully we'll have some time at the end to take any questions. So over to you, James.
Thank you, Sam. Much appreciated. Good morning, everyone. Okay, let's move into the exciting world of scheme governance, oversight and supervision. If you just want to go down one, Sam, yeah, just leave it there for a sec. So my team, we work within market oversight, and our overarching role is to manage relationships across the market, as Brady alluded to earlier. So one area centres around how pension schemes are deploying essentially systems and processes to monitor and manage client payments. So that's to ensure the right contributions are being paid across. So we work across schemes, like I say, but also deal with employers in this situation as well. And that's to make sure that we're fulfilling our role as TPR and protecting those member benefits. Do you want to jump down one, Sam? So scheme focus, so scheme oversight. So you may or may not be aware, maybe may not, depending on your experience in with the pensions market. But TPR supervises authorised master trusts. All master trusts out there now are supervised, and we carry out supervision, everything from investment, policy, governance, and that through to the systems and processes that underpin all of that. So the FCA typically oversee GPP schemes, so those big insurers out there in the market. But TPR, we still have remit with those when it comes to monitoring and the reporting of late payments from employers, essentially. So my portfolio, we typically focus on the more significant providers out there. So manage relationships with the likes of, you can see some logos down the side, but Nest, People's, Standard Life, and many more. But that doesn't mean we ignore others. We will reach out to wider market where necessary. So we will deal with all types of pension schemes. But in order to get maximum coverage, we do focus on the most significant providers. It won't come as any surprise. Being a regulator, TPR do issue codes, and we set our expectations. All those codes are obviously based on underlying legislation as well. But we're there really to seek to improve the standards across the market. So this means for me and my guys, we're actually out with the schemes at their offices. They're always pleased to see us, as you can imagine, viewing how their platforms work and how they are validating client data and managing that data and monitoring payments that are coming through. This is obviously just one small area of the work that we do, but it's really relevant for this audience, I think. So that does mean that schemes, controls and balances do slowly change as systems and tech improves. We've heard AI mentioned earlier, and yes, no surprise, we do have those conversations as well. The market is innovating in many different ways, and that does mean that clients are getting better insight into their, schemes are getting better insight into their client books, so at member level, whereas before, years gone by, legacy products, they would pretty much be operating on a larger scale, but now it's on member level because there's much more data. The expectation is the data is coming in. So why am I telling you this? So what does this mean for you and the services you're probably providing? Some of the services you're probably providing around pensions administration. So here's my regulator bit. So we need to make sure that you guys out there, you're key to this. You really are key, because we need to make sure that you're providing accurate data on pensionable pay. Sam's mentioned the pensionable pay elements earlier, but in the schedules, so accurate data on pensionable pay includes salary information, the employer and the employee split in terms of what's going across for pension payments. It's obviously really important to make sure people are getting the right money in, but also ensuring that prompt leaver updates are being provided as well. So schemes know when someone has departed an organisation. It's not just left for months on end. National insurance details, I can't stress that enough. So NI numbers need to be accurate and up to date. Names of members need to be accurate. So it's just that admin side of it needs to be kept really accurate and up to date with the pension scheme. And finally, I guess on when you're submitting schedules, making sure that any reasons for in the schedules or on the platforms that you're probably starting to experience now, any reasons for payments which are not meeting the full amount or they're missing, put in that valid reason code so the scheme know why, and then it means your employer, the client, doesn't get reported. Now, for those of you you probably would have seen some changes recently. So People's Pension is one of them, People's Partnership as it's now called, Royal London, Scottish Widows and many more. They've all made recent changes to their data requirements, and you will see that slowly start to filter through to you guys when you're uploading your schedules, and there's various levels of whether they put a hard stop on it, but you can start to see that there's more data required. The likes of Nest, I'd imagine many of your clients use Nest. They've always had that requirement to provide a certain level of data in there, but you will see those changes come in the level of data that you're expected to provide. So part of our work as well, we also have a sight of how pension schemes are trying to resolve those payment failures. So they don't just ignore them. They will be in contact, and no doubt you've seen them. They will be in contact with your clients, chasing for those payments and trying to get them resolved. And finally, worth noting, we do expect the market to contract over time, The new Pensions Act's just come out, and there's things in there like value for money, assets under management requirements, etc. And this will see the market contract over time. So you might find that some of your clients end up moving from one scheme to another. If we just jump down one, Sam, and we'll move on to reporting. So I've talked in there about the need for schemes to monitor and report on what happens when payments don't come into them. They do have a duty to report these directly into TPR, and it's typically done online. The little screenshot you can see there is just elements of the data that they provide to us. There's nothing sensitive there. It's telling us who the employers are, what's missing, etc. And that is done online. That's a single employer one, but a lot of schemes out there are reporting to tens or hundreds or maybe more than that to TPR every month. And schemes must report material payment failures to us. The most obvious one of them is non-payment, but you should also be aware that they will look at wider employer behaviours such as underpayment. They're starting to pick up on underpayment a lot more frequently. So if they think it's not the full amount that's come across, you can expect that to start being reported across the CPR. Any clients who persistently pay late, so poor processes and administration, that can become material. They will report that to TPR. And obviously the more serious issues like fraud or unwilling to pay, that can come through to us as well. So hopefully not many of you have been on the end of these, but where a client hasn't paid, TPR will undertake an enforcement regime against employers, and that's purely to recover outstanding contributions into the scheme. It starts with an unpaid contributions notice. Like I say, some of you may have seen it. That typically runs for 42 days, and we extended that out so it covers a full pay period, so give you a bit of time to work with your client to get it paid over. And some of the real issues we see are single point of failures within an employer. So where someone just doesn't pick up the role, or they think, like Sam alluded to it earlier, they think someone else is doing it. That can be one of the main causes of non-payment and why clients get reported into us. Our enforcement is automated. We get thousands of these in a month. Our enforcement is automated. So you will find that if you're dealing with one of these, you'll have clear instructions of how to deal with it in the notices. But you might also find actually some of our cases are dealt with by a case manager. So you might find you're being spoken to by someone if you're the dedicated or the allocated representative to help try and fix this problem for your client. The real thing I would say here is acting quickly. We don't want to issue financial penalties, and we allow periods of time before those financial penalties kick in. So we've got a fixed penalty notice and an escalating penalty notice, but act quickly, work with your client, and get it paid over, and then no one ends up getting an unnecessary fine from TPR. I'm just going to quickly cover two examples if we move down to the next slide. So the first one is around tax relief issues, and this could be one of the reasons for underpayments getting picked up as well. But so tax relief has become an ever-growing problem in my life, to be quite honest with you, and it affects all types of employers with various levels of complexity and impact as well. The one thing I would say here is it's for the employer or their rep to ensure that payroll is set up correctly and using the correct tax basis of the scheme. Schemes might pick it up through their processes that they're deploying to monitor whether payments are accurate, but that might be risk-based. They might not pick it up for some time, and it's not their responsibility to spot a payroll issue set up. So that's one thing to really be aware of. The example on the screen here talks about where members were not having tax relief applied to their pots. So bad news for them because they weren't getting the relief from the government in relation to that. So and this simply happened when they move from one scheme to another. It's a large client. I don't know how many of you would deal with a client of this size. They're usually they're pretty rare out there, let's be honest. But if schemes of employers of this size are getting it wrong, then you can be sure that the problem is widespread spread across smaller employers who struggle to understand tax relief at the best of times, along with many of us. And this really was a simple failure just to check that whether the payroll was set up correctly in the first place. So it becomes a bit of a headache because then you start then you would be expected to look backwards, calculate different calculations and work backwards and potentially with HMRC. We get it for double tax relief as well, and when HMRC want to claw back money, an even more difficult conversation to have particularly between the employer and their workers. So really, what my one plea here on tax relief is, if you just really have a check, if you're moving schemes, setting up new schemes, everything in payroll, have a look and check to make sure that it is set up on the correct basis. Really conscious of time, so I'll whiz down to the last slide. But this one is highly relevant. So this is an example here around administration and how much of it can have an impact. So I shall whiz through this as quick as possible. But what we have is an advisor who essentially had a group of employers who they were looking after. They set up one scheme within a GPP provider. And unbeknown to the provider, what they were doing is they were just putting all of those workers from all these different employers into this one scheme. Therefore, what we've almost end up with here is almost like a mini master trust being created within an insurance product that's being offered out there. No one wants that. It's an absolute disaster in terms of admin and trying to sort it out. So yeah, we ended up with a mini, almost like a mini master trust multi-employer scheme within a GPP, and this went on for several years. So as you can imagine, years later, we're now trying to unpick missing data, establish which members didn't have payments, which employers are non-compliant with their duties. We've got people who have left employers, people who want to take their retirement, and it's caused no end of issues. So, and it's just really to reference a point in there, sort of about halfway down in the slide, I talk about what the accountant was doing, unfortunately, was if they didn't receive any contributions from one of those clients that was in this pot, if you like, they would just zero in contribution levels or fudging the data that needed to go in order to force it through. And obviously, years down the line, we've now got to try and unpick that and reconcile. So the point here really is around good quality administration. It really is critical to the scheme, to your clients, and poor data and admin will undoubtedly lead to poor outcomes, and the people who pay that price will be the workers who then have to try and have it resolved for them. So clear processes, good records around data, member information, and payments really is essential. I appreciate we're pretty much run out of time, so I shall stop there, Brady, and let you come in.
I didn't want to stop you though, and I was going to say, there are a few questions. I know some people will need to drop off at 12. No need to excuse, but if anyone can stay for a couple of minutes, and if we can answer a couple of questions, I think there's a few there for you, James and Sam, if that's okay. Obviously, it's been recorded, so you'll be able to catch up later. Are you okay to stay, James, for a couple of minutes, and Sam? Yeah. It's so interesting, and I'm by no means any kind of expert on this, but there are so many things that I hadn't thought about before. But kind of that we talk a lot generally about clean data and the importance of that, but also with this, there seems to be a lot of intent. There seems to be a lot of not intentional mistakes, but intent as well. And I guess as a regulator, that's really important to identify that with this. So trying to make sure you have all the right systems and processes. But having said that, the other thing that was interesting is I think people probably expect their scheme providers to do, or they think they've got a good scheme and therefore there's some safety there with that. But that also isn't the case either. Right, shall we just quickly look at some of these questions? I'm going to go, bear with me. I'm just, what's the situation where an employer employs on a strict casual basis with no long-term employment relationship? Are you able to answer that one, Sam?
So if the individual meets the definition of a worker, then they must be subject to automatic enrolment assessment. So one thing the employer can use in that situation is postponement. So the employer can postpone the assessment again for a period of up to 3 months. So if you have someone that's on a real short-term contract, they're going to work 2 months tops, you can use that 3-month postponement. They'll join, you'll assess them, and then you'll postpone the following assessment for another 3 months. If on that postponed assessment, the deferred assessment, they still meet the criteria for auto enrolment. They must be automatically enrolled, but it does give you that 3-month period. So anyone on a short-term contract, they might not be there by the time you get round to that next assessment.
Awesome, thank you. There was another question. Could you explain which method does reduce pension? I think she's talking about the tax. Net pay arrangement is when an employer pays tax through an employer and PAYE, question mark.
So the net pay versus RAS. So I always find relief at source quite difficult to explain. Net pay is much easier. The value of the pension contribution for a net pay arrangement reduces the employee's taxable pay by that same amount. So if you earn £1,000 in a month and £100 is going into the pension pot, you're taxed on the £900 left. So the £100 pension contribution directly reduces your taxable pay in the period. So that's where the tax relief is for that worker. With relief at source, the worker gets a 20% tax relief. I would perhaps the easiest way to explain it, the 20% tax relief is applied to the percentage. So every 1% of pension contribution becomes 0.8% for the worker. So the worker puts in 0.8% of every 1%, and then that goes over into the scheme, and then the extra 20% to bring it up to the 1 is topped up by HMRC. I'm not sure if I've explained that clearly, but yeah, that's the best way I can explain it. The tax relief is on the percentage.
Yeah. No, thank you, Sam. There's one last question I'm going to quickly. What if you get a bonus? Can it be added to pension tax-free?
Can it be added to pension tax-free? It can be. Some schemes you can salary sacrifice a pension contribution. So by salary sacrificing it, it doesn't have tax and national insurance applied.
Okay. Great. Thank you. Thank you so much, Sam and James and Dan, for giving up your time today. Really appreciate it. It was really good session and great questions there from our members. Thanks for interacting, everyone. And again, great to have met so many of you at Accountex. Look forward to seeing you there next year, if not before. I hope everyone has a nice rest of their day. I shall let everybody go. And yeah, thanks again.
Thanks, Brady. Thanks for having us.
Thank you.
Bye, everybody.